Hello, Tom. How are you?
I'm great. It's been a great morning here.
How do you see a happy retirement? Because I read in your book actually the words of your wife, and she said that you're golfing, dancing, cooking, painting. I have all the list here: fishing, landscaping, reading, and even making a wine. Is it a recipe for a happy retirement, or how do you find time for investing then?
Yeah, I my wife's foreword of the new book is probably one of the most popular chapters in the entire book because it she let me have it with all that goes on in my personal life and all that, which was it was okay with me. It is what it is, and I think retirement obviously is different for different people, but for me, it's doing some of the things that when you were working, and boy was I working. I mean, my Trenstead days were some days were 16 hours, a lot of times traveling around the world. A lot of my currency clients were in Europe or Far East, and a lot of time on planes, a lot of ability to read books and try to catch sleep where you can and change time zones and everything else. But when you retire, now your time is your own, and you can, yesterday morning I was working on an idea I had for investing. So I spent 3, 4 hours dealing with extra work in the investing area. But yesterday afternoon, for instance, at about, I think about 5 o'clock, we went out and played 9 holes of golf. And it sort of just, you sort of schedule your day around different types of activities that amuse you that you really couldn't do if you're not here all the time. I'm not in Scottsdale or in Payson, Arizona, where I am right now up in the mountains. You can't really take dance lessons. So I always wanted to learn how to dance. I have a very good friend up here in the mountains that was on American Bandstand back in the day. And he grew up in Philadelphia, and he would dance with all the kids, teenagers. He's now, older than I am, and so this was very early American Bandstand. But he was always smooth on the dance floor. He always seemed to be having a good time. And I thought, hey, he's not a rocket scientist. I should be able to figure this out. And so, one thing led to another. I took dance lessons. I met Brenda at dance lessons. So, one of my other interviewers titled his whole interview "Blame It on the Bossa Nova," which was a famous line from a movie way back when, or I think it was a song actually. And making wine. I've always loved to sing. I sing in a choir. I'm a bass voice. Baritone probably be my sweet spot, but I can get down to bass. And interestingly enough, Basso, my name, is bass in
Yeah.
Italian. So
Oh, I didn't know that.
the basso voice of the choir is me.
All right. Great.
But all the other things I do, I love to golf. I love to work out. We've been doing a lot of, in the hot summer of Arizona, we've been doing water aerobics, and we make up our own. We've gotten books and tried to figure out certain exercises, but it's amazing how when you're pushing against the water, it's so gradual on your muscles that the next day you just feel tight. You don't feel sore. And one of my biggest gripes as I've gotten older about working out is that the next day, getting out of bed is tough. Sometimes I'm pushing 69 now, and man, if I do a good weightlifting session or 45 minutes on the elliptical on 10, I'm pushing pretty hard. I'm sweating profusely and I'm feeling good. But boy, the next day, oh man, it hurts. And so I like the water aerobics. And when it's a hot summer day in Arizona in the desert, it's kind of something nice to just jump in a pool and do all your exercising and stay cool at the same time. You don't even break a sweat. So, and meanwhile, I'm breathing heavy. I mean, you're really out of breath and all that. So, to me, retirement is filling your time with things that you never had the chance to do, that you always had that hankering to do, but now you do have the time. And I think you have to embrace that and go for it. I don't think just sitting around watching the television or, staring at a screen all day. I don't stare at a screen all day. That's the last thing I want to do. I did a lot of that most of my life. So I want to be outside. I want to work in the garden. I took courses in pruning and landscape architect just so that I could understand more about working with all the plants in my at my house. And just I have a lot of interests. And cooking. I took cooking classes. I didn't know anything about cooking, but I'm always hungry, especially when I'm working out a lot. So might be nice to know how to throw together a dinner. And now I'm putting on 4 or 5 course charity Italian dinners paired with wine for people that will pay $1,000 to a charity so that they can come to my house and let me cook for them. And that's kind of fun, raising money for good causes and get to meet new friends and get to test myself with pushing the envelope on cooking. So lots of things. I All of them are unrelated, but I guess the only common thread is that they take time and my intellect, and I really enjoy them. And they're things that I really couldn't do back in the day when I was on a plane going to Japan or something. So
Sounds really great.
yeah, it's been good. I'm a poster child for retirement. I love retirement.
And on top of this, all activities you mentioned here, you're also still an active investor. So, how much time you have to dedicate just purely to manage your own account? Because now, after retirement, you're just only managing your own account, right?
That's correct. I have 2 accounts, an IRA and a personal account. And Brenda, my wife, has an IRA and a personal account. I have 4 accounts.
Right.
And hers are pretty easy the way I do it, and mine are a bit more complicated. My IRA is fairly simple. Some ETFs and a position in an all-weather fund that I'm the chairman of, Standpoint Funds. I've got some of that in my IRA, and that's a great way to take care of some futures exposure in my IRA without having to manage it myself. And then on the individual side, for me, that's where I really concentrate my efforts because that's where the money would be, where we would live off of, and pay the normal monthly fees for various things. And so I try to do a good job of that. Now, if I'm doing some research or come up with an idea, like I did, like I said yesterday, I was working on an idea, and one of the ideas that I had that caused me to work for 3, 4 hours yesterday was to replace some of the markets that I trade where I only get, say, one contract because my account is not infinite.
Hmm.
And things like, for instance, lumber have been moving so fast that their volatility is so great that you're down to 1 or 0 contracts with the dollar size. But a lot of the markets are coming up with micro contracts now or mini contracts. So I think there's a crude oil contract that's now half the size of the big guy. So if I'm trading 1 or 2 contracts of crude in my normal contracts, I now could trade 4. The reason that's an advantage is that if you've ever read my book, Successful Traders Size Their Positions, Why and How, I've got all the math in there. Uh, what ends up happening is when you get into a trend following move, your return to risk is the best that it's ever going to be for the rest of that trade. It'll never get better on average. Could get better in an individual
Hmm.
sense, but on average, taken over thousands of trades, your best return to risk ratio is the second that your trend following model goes over. Given that, and given a market like, say, lumber or a crude move that goes crazy or anything, stocks, what'll happen is you've got a stop loss. You've got the market taking off through the top, and you're buying into it. As this market accelerates, if you can't move your stop up as fast, look what's happening to your risk is getting bigger and bigger and bigger and bigger. And that can eventually come back and hit your stop on certain situations. It's not going to go forever, and it's probably sooner or later is going to stop you out. So what I figured out a long time ago when everybody in the industry was looking at my return to risk ratios is that your next drawdown always starts from your equity peak. That's when your risk on that trade tends to be very, very high. if you don't cap that someplace and peel off some of your positions so that you have less positions on, you're going to end up with starting your drawdown with a full bore position that's going to end up slamming you when it goes the other way. So in order to reduce drawdowns, I figured out that if I could set my risk limits at some reasonable level, both on the portfolio and on a position, I could end up peeling off trades. Well, if I start with 4 or 5, I can peel off 1 and still have 3 or 4. And if I can then I get more risk, I could peel it off and go to 2. If I'm starting with 1, I can't peel anything off. There's
Right.
nothing to peel off, or I go to 0 and don't participate in the trade. So in order to try to smooth performance, I'm looking more at the micro and how much additional trouble that would be and whether it's worth my while. So I ran some simulations. I did some thinking going through the specs of the micro futures. And the other thing is, I get so many questions from traders who are starting out with, say, 25,000 or less even. And they ask me, well, how can I do a futures portfolio? And I'm inclined to say, back in Trendstat, the smallest we would accept was $1 million. It's kind of hard with some of the contracts doing what they're doing with the volatility that's out there to think of trading smaller futures portfolios. You're going to be very over leveraged. And but with the micros, you've got some, like gold is 1/10 of the contract size of the normal gold contract with their micro gold. Silver's got a 1/5 size COMEX position at 1,000 ounces instead of 5,000 ounces. So the exchanges are starting to wake up to the small investor. I really like it. And so I wanted to really dig in and find out who is offering micros, what are the specs, so that in the future, when I get these questions from new traders, I can point them in the right direction and say, you got to check out the CME group's got a lot of micro contracts that are looking pretty good and you could get your exposures down. So that's
Right.
kind of what I did yesterday morning. But other than that, a normal day, half an hour, 40 minutes
All
is
right.
all I
And that's
spent.
it. And that's it. Okay. I had you already on my podcast almost 3 years ago,
Right.
and I'm glad I have you another time. And there's a good occasion for that because there's a new book by Michael Covell, Trend Following Mindset. Could you please tell us a bit about that new book, and also what does it mean to be a trend follower and to have such a mindset of trend follower?
Yeah, the trend following. First, let's start with the book. The Michael is a great interviewer, as are you, as I
Thank
pointed
you.
out before we started. And Michael's always very well prepared, but he does not tell me at all what he's going to talk about. And we have such fun. He and I
Surprises.
have very similar attitudes towards a lot of things. And we, he just hits me with these off the wall questions. I just love them. So I think we've done it 4 times or something like that. I know he's had 4 podcasts, but one of them is what he calls the Super Basso episode, which is I don't know, like 4.5 hours or some crazy amount of interview all at one shot. And so he can call me from anywhere in the world and off we go. And usually an hour later, we wrap it up. And we decided that a lot of people just aren't into listening to podcasts. They like to see the hard copy. And he's had all sorts of suggestions from people that will listen to his podcast to say, I would love a hard copy. I would read your podcast, but I can't listen to them. I don't like listening in the car. I don't listening while I'm working out. I need hard copy. So Michael says, well, then you're going to have somebody transcribe it yourself because I'm not going to do it. He's just adamant. He likes his audio. He also doesn't do video. He
Mhm.
very rarely has ever done Zoom type things except for public speaking. So he has his little niche that he's done, and Lord knows he's very successful at it. He's way up in the millions and millions and millions of views, and so we decided, we've got all this material, and I said so many interesting things. Why don't we take that as a starting point, combine it together with another interview I did, wrap in a forward from my wife, wrap in the research that was on my webpage, try to pull together a lot of good material for traders and put it in one place. So they have sort of a reference. They can underline things physically. They don't have to remember that it was at 23.21 in the audio broadcast. They can say it was on page 100, and they can even put a
Right.
little tab there if they want, or a paperclip. And so things about position sizing, the mental side of trading, things that I've said over the years, it seemed like if we could pull it together and put it in one place, it would be fun. Now, we called it the trend following mindset because a lot of the interviews in the book are about the mental side of trading. And I always say there's really three parts to trading that are identifiable easily and that you could say are essential to the basics. The first is what everybody spends time on, which is the buy sell engine. It's, I'm going to buy when the moving average crosses. I'm going to buy when it goes through the Keltner band. I'm going to buy when it's oversold, and the RSI stochastic gets to 20 or whatever. Everybody's got their own buy sell engine, but a buy sell engine needs to trigger you to act and buy or sell. That's fine. And everybody spends all their time looking for the perfect one or a combination of them. And I would say that's the least important thing in trading. The second area, which I think a lot of new traders, because of their capital or because of their lack of knowledge, do not address, is the sizing of the positions. That's why I wrote the book and charged only $10 for it. And everybody could afford it. And it's got all the math in there that we actually did at Trendstat in the real world. So it's a great book to get an understanding of what position sizing is about. It's not the only way that you can position size, but to me, it's one of the simplest so that a normal new trader can do it. You could get into some very complex position sizing, but I think it's beyond the scope of most traders. That's more important than buy sell engines, it turns out. If you randomly flip a coin and run Monte Carlo simulations like I did back in the day, but have great position sizing and trail your stops and do all the things right with a simplistic little moving average, flip the coin at the end of the day, buy the next morning or sell the next morning, and just once you're in, you just move your stops up. I showed a slight propensity to produce a profit over like a 20 market portfolio in futures. It was not highly profitable. I would not want to trade that as a trading strategy, but it proves the point to me that sizing your position is far more important than just worrying about where you buy and sell. Because if you can get on a trend and I don't know, gold goes from 500 to 1,000 or 1,500 to 3,000 or whatever it wants to do, you're going to make a lot of money. And whether you got in today or tomorrow or yesterday, not going to make a lot of difference. The third area and the most important area is what most of the mindset book is about is the mental. Now, why is that? I'm a systems trader. I just said that it takes me maybe 20 minutes to 40 minutes every day, and I'm running 8 strategies across 20 something futures markets, index stock and stock indices, 4 different stock indices. I'm running one on a futures on a cryptocurrency I just started up a couple days ago. Haven't even done the first trade on that yet. I run 2 different ETF portfolios, but one by momentum and one by trend following. And one's a sector and one's more momentum based. And I do all that in 20 minutes to 40 minutes. I'm very systematic in how I do it. Well, why do I have to worry about my mental side? Well, because with Tom, the human being, there's all sorts of ways I could step in and screw that up. I could say, I don't feel like doing my work today. We had a good day. The positions aren't really very close to my stops. So I'm just going to go ahead and go out and play golf. I don't need to worry about it. And of course, that would be the next day would be the day that everything turns and crashes. And then all of a sudden your stops are not where they should be and everything's messed up. And you could always step in and say, I don't feel comfortable. Lumber just went up, like 5 straight days limit. I only got one contract left, but I don't feel like, keeping or staying around with this. I'm going to take my profit. What's that? That's the mental side stepping in and being greedy and thinking about what what that means. And I think that, so you see how, if you the person can't even run the systematic, then you're lost. So all the same buttons get pushed on me that get pushed on any trader, which is potential greed, potential frustration, potential anxiousness about a position, or fear. You have to learn over time how to deal with a lot of that. So the trend following mindset really is an attempt to try to explain that you need to be able to get into a position. You need to help yourself by controlling your position sizes and controlling your buy sell engine so that it fits you, the person, your situation, your capital needs, your skill levels. Do you know math or not? Do you know computers or not? Do you are you trying to day trade? You're trying to trade over a month. There's so many different aspects. Take an inventory of yourself, and you are completely different than me. So there's no way that both of us should be trading the same exact approach. One of us would be very uncomfortable. If I traded what you do, I'd probably be uncomfortable. I'm totally comfortable with what I do because it's designed for me in every aspect. And I've taken a lot of time to design it for me. When I was back in the business, I designed everything for my clients, not for me. So I'm trading different than what I would do for clients. If you force me to trade client money today, I would change what I'm doing, and I'd back off the risk a little bit, back off the volatility. I'd probably expand the markets. Um, I'd probably go a little more long term. There'd be a lot of that type of stuff that I'd have to modify to suit my average client. And I think that's what people miss about the mental side of trading. It's so important because if you're not comfortable, sooner or later, a sleepless night's going to get to you, and you're going to have enough pain or enough greed or whatever. It's going to come in and rear its ugly head, and you're going to end up modifying your very systematic approach, and you're no longer a systematic trader.
Right, right. I even saw words by Larry Hite on the cover of following trend following mindset, and he said that anyone can make a lot of money without the trend following mindset, but you will never keep it. So basically, so as you
Larry's a
said,
good guy. Larry is great. Larry is the inspiration behind the early stages of my risk controls that went into the book, actually. And he did not share those with me. I just read Market Wizards, and as being the mathematician and engineer that I am, as I was reading the chapter, and I had some trades that had gone over in the previous month or two, and I'm reading the chapter, and he's talking about keeping every single bet size time after time the same. And I immediately saw math of, okay, I can do a risk in each trade divided by the equity so that I know how much money I have in my account. I can expose a certain amount to it, and I can do that math and figure out how many contracts I should put on. And that would keep the bet size relative to my equity the same. And I later developed, after the famous silver trade, which was also covered in the book, and also covered in New Market Wizards, Mr. Serenity chapter, with Jack Schwager. I covered, uh, you know, the volatility was way too much on that trade. So I used the same concept. I thought, hey, it works great over here, risk side. Why don't I look at controlling volatility too? And then later on, when I was trading euro dollars uh, for Trendstat, I was thinking, wow, if the volatility is low and the risk is low, I could get a humongous position in euro dollars, and all it's got to do is have an interest rate move or something, and I'm dead. I should put a margin limit on it too. So I put a margin to equity, just like I have volatility to equity and a risk to equity. That controlled everything. And then you could sleep at night and just do your job and keep cranking it.
Um, do you only trade using a trend following approach, or do you also maybe use some short term approach like mean reversion? You mentioned already about the momentum, so I will get back to that in a while.
Mhm.
But just are you using something which is, let's say, like mean reversion, let's say shorter
Yeah.
term?
Yeah, I would say, yes, I am using a wide variety now. Lawrence Bensdorp is a friend of mine down in Brazil and runs the Trading Mastery School. And he and I do some seminars every now and again. And just sitting in those seminars is inspiring to me because you have a lot of great minds, 12 great minds in one room. These are many times not brand new traders. They're pretty seasoned and they're trying to take it to some sort of an ultimate level. And Lawrence and I switch off every other hour and a half, I guess it is, so we can rest our voices because it is fairly exhausting for 2 days
I can
being up in
imagine.
front of a room talking about trading. And but I sit there and listen. And Lawrence wrote an excellent book on automating your stock portfolio that talks about multiple systems trading. And he's a big proponent of long-term trend following, but he's also a big proponent of blending in other strategies like mean reversion. And I think the book's excellent, easy to understand. I recommend it to a lot of people. And what that book has inspired me to do is to think long and hard about how do I fit into my own comfort levels the concept of diversifying by strategy. So, the first and easiest way to do that I found was to go from my longer term trend following with futures, let's say, to look at a shorter term time frame, very, very shorter compared to the long term. So that was the first area of diversification was by time period. And that was easy to do. And it's basically using some similar trend following triggers, but over a much shorter time frame. So you're going to get very, very different return streams. And sometimes when you're pulling back on a drawdown on a long term position, your short term position's already flipped and you're basically neutral. One's losing, one's gaining. And when they both kick in, then you really rock it again. So that was one thing that was easy to do. The second thing I decided right out of the gate was, unlike Lawrence, pure mean reversion to me, it means you are literally, like an example of a buy, and you got, say, an RSI stochastic or something. So
Hmm.
you're going from 0 to 100. The market comes down. You're looking for a buy. It's below 20, still going down, and you've got to put a limit order in to buy it under the market and hope you get it and hope it goes the other way. That is just not me. I just don't. I would rather do something like, okay, I'll see that it goes down to 20, and now I know I need to buy. I'm going to trigger myself like above the previous day's high or something, a 3 day average of something, or a 1 day, 2 day average of something, the breakout of the last 2 days, or I don't know, something that's so small and short term that it looks to the outside observer sort of like I've got a mean reversion, but I'm really very, very, very short term trend following. And that just feels more comfortable to me. And I know where to put my stop. And I don't know, it fits my mentality so that I can continue to do it. Lawrence loves his mean reversion, and he does very well with that as well. We both had good years last year doing very different things.
Yeah,
So,
but as you said, it's very important to have the strategy which is really fitting into your nature and that you can feel comfortable with it.
yes, that's the perfect summary of that. So I, that's what I've ended up doing now is to try to look for new markets and new sort of overbought, oversold, very short term, sort of mean reversion looking guys that I can blend in. So I've added an extra ETF program. I've added some index trading that I would almost call counter trend. It's from overbought, oversold conditions and always trying to go the other way. Uh, I've blended in one Bitcoin future just to start experimenting with that, see if there's enough liquidity. There seems to be enough volume. I don't know how trend following on a very short term basis is going to work there, but it appears like there could be some potential. So we'll give it a try. It's not going to hurt me or help me that much to get started, but then it's one more return stream. So what I'm looking for is unrelated return streams. And Lawrence, as a way of saying this that I think is so perfect, if you ever looked at an equity chart, it never goes straight up the page. It always is, little
Bumpy.
little, and then sometimes there's a little bit of a bigger one, right? A little down and up. And if you leave it alone and you keep following your strategy and it's well thought out, you're probably making new highs sooner or later. You just have to have that patience, which is the hardest thing to do on the mental side of trend following in the mindset area. So what he calls it is filling the holes. The drawdowns are the holes. And just like you would fill potholes out in the street by shoveling something into them and kind of topping them off, if you really examine that time period that some of your existing strategies went through and what did they do to struggle, what types of markets were they trading, type of strategy were you using, how long was it, and all that, what if you were to just design a strategy with perfect hindsight that would tend to be a math that would tend to make money during that hole, that drawdown, and maybe some other drawdowns as well, it wouldn't have to make money, a lot of money, over the very long run, like your big trend following models might, the core positions, the whatever is really the engine driving this equity curve going up the page. It's designed to try to fill a hole. And if you think through your rules enough and you really design it so that its job is to fill that hole, if it doesn't fill that hole on the next hole, out. It didn't do its job. You can develop math, for instance, that like mean reversion, that ends up trying to offset some of the early trend following losses with mean reversion profits. Now, if you get then a big downswing, and it's a steady down and a panic down, you're going to be trying to buy with mean reversion. You're going to lose on mean reversion. So you got to be very careful to not create other drawdowns with your mean reversion that are offsetting your trend following profits. But that's a matter of sizing your strategies, dealing with the sizing of positions, and so on. But I found that to be a very fruitful area of research that I've gotten into, where I can do sort of hole filling projects that end up expanding the number of strategies I do, but not really expanding my time too much. If I take a stock index and go to a stock index trade because my ETFs are longer term, if I do stock index trading on a short term basis, then I can be short NASDAQs at the same time my momentum strategy might be still coming back to its loss points, and they're sort of offsetting each other. So what I'm constantly trying to do is, if one thing I know has got a Achilles heel or a soft spot where it's going to tend to draw down, what other strategy can I design that tends to make money during that, but won't cost my returns too much during the rest of the periods? So that's been the largest amount of research lately that I've done.
You mentioned about momentum, and I wanted to ask you more about that because what's the main difference between momentum and trend following? Because the core idea seems to me similar, right? We are looking for some momentum on the market, but I
Mhm.
know also that okay, trend following is based on trading primarily futures contract. Whereas momentum often is used also for ETFs. Now it's easy to trade indices using ETFs. So as you said, for example, there is a problem for people with a smaller capital if they want to trade contracts, but maybe it's easier for them to use ETFs.
Mhm.
But what's the main difference between these two approaches?
All right, I would qualify what you said a little bit differently. I would say that momentum and trend following purely are sort of um, two different forms of trend following. So I would call trend following sort of a grandfather of a lot of different math that falls underneath that large
All
category.
right.
Momentum to me is you're trying to find, say, ETFs or stocks that are moving really well compared to the rest of the universe. And you would buy them when they're moving very well and looking like they're increasing in their momentum. And once they fell on hard times or ran out of steam or whatever, out they go and the new guy comes in. You just keep hitting the fast moving. Well, aren't you then going with the strength and cutting your losses short with the weakness? That's trend following. So trend following is more of like an to me a label that could apply to an awfully lot of different maths, moving averages. You could use trend following with Keltner's, Bollinger's, Donchian channels, moving averages, high-low price ranges. There's just a ton of. If you go to investopedia.com, you'll see about 100 different indicators that you could probably use to trigger a buy or sell. So to me, trend following is a little bit more of the label over all these things. Momentum's a specific subset of that. So what I'm doing with my two different ETF approaches is in one case, I've selected one sector fund with a very low cost structure, lots of liquidity in each of like 20, I think it's 23 different sectors, if I remember right, something like that. So I identified a precious metals ETF. I identified an emerging markets ETF, a technology ETF, an aerospace ETF, et cetera, et cetera, et cetera. And then what I use is I use just pure buy sell engines, trend following over I use it like 21 days to get in and 50 days to get out because I feel like it should be slanted to the upside. I make it harder to get out than to get back in. And that worked really well during COVID. It got me out of everything during the crash, and it got me right back into everything fairly quickly on the upswing last year, which has helped drive my
Right.
very large returns last year. The that I call trend following, and I think that it's just using buy sell engines, position sizing, and away you go. Diversified portfolio. I know I've got 23 different sectors I'm trading, so covering a wide base. Then over in the momentum side, what I decided to do is take another chunk of money and I said, let's go into some screeners that I've got at my broker and gear them so that it measures the last 30 days of relative strength versus the universe. So it lists the highest, I don't know, 50 ETFs by that criteria. So all of a sudden, a Russian ETF will pop in, or I don't know, like computer hacking, computer security
Mm.
firm will be up there, or an ETF that specializes in cybersecurity, or another one could be extremely mega capital, high cap stocks. All of a sudden comes in, and they you can kind of see themes coming in, which has kind of been fascinating because I've been doing it for a few months now, and I've noticed it definitely kind of changes. All of a sudden I'll get a whole bunch of cybersecurity stocks and they do well, and then all of a sudden some other area starts showing up, and I'm into now, mega capital stocks or something, or tech stocks, or emerging markets, or country stocks, or whatever. Uh, and so it's been fascinating. But what I do there is I buy the new positions that show up. So buy a small position of them, and then I put a trend following stop behind them. Or if they fall off the top, if they get to basically 60 or less on relative strength, they've lost their mojo, they're out.
Right.
So I've had as many as see the maximum. I think I had like 25 positions or something in the portfolio. Right now I have 10 after
Right.
yesterday. Yesterday was a fairly big down, and it stopped me out of several. So
And are you religiously following all the signals, or you
mhm.
have some room for, let's say, gut feeling that, oh no, the signal is
stops
signal.
stops are in the market. I
Right.
I'm stopped out, and I don't even know I'm stopped out until I
All
do my
right.
work at the end of the day. I'm already out.
All
I
right,
don't
I understand.
I'm doing something else. I'm doing an interview or whatever. I can't be sitting here trading while I'm doing an interview.
Sure. I mean, as you're a systematic trader, investor, um, but there is one problematic thing, namely, if the market is changing, you may be asking. I mean, investor may be asking question: are these changes so significant that maybe the model has to be changed, adapted to these new changes? So, first of all, how do you see that? How can you tell that this is the moment to change the model? Because that's also, that could be also a way how to avoid following the strategy, just constantly modifying it. But on the other hand, there may be a moment when indeed we have to do it. How do you approach it?
My tongue-in-cheek answer to that is it's got to be your models have to be doing something that you would not expect them to do given the market conditions that you're facing. So one of the reasons why I'm so adamant with traders, new traders always want to say, well, how do you do it? What indicators do you use? What markets do you trade? Well, they all want to clone me. And I keep telling them, you're not me. Don't clone me. Design it for you. The reason Another reason you want to design it from ground zero is that you want to be able to understand what you're doing so well that when you see the market do something and you say, you know, given the market action that's going on here, I should be making money, but I'm not. Something's weird. And you dig in and you start realizing that, that one little thing that you did way back when was is going to affect you. The strategy that you have with the math that you have is not going to handle what this new thing in the market's doing, like the meme stocks, for instance. You know, uh, Somebody says AMC should go up and they publicize it on a bulletin board. That's a little bit outside. If you're doing a momentum play, well, then you're going to be in on AMC stock, right? It's shooting up 600% or 6,000% or whatever it is. And so you have to try to figure out, okay, that's something new. There was never bulletin boards that could have that kind of impact on the market. How do I incorporate that into my strategy or deal with that? And that's a good time to think about making changes. Other than that, if you're just losing money, let's say on a strategy, the temptation is to change it and to
Mhm.
say, if I had done this instead, I wouldn't have lost as much during this drawdown. And so I'm going to modify it. But what you don't realize is that you're already doing uh, a strategy that spanned lots, decades on your simulations or whatever. And now just one little thing causes you to change it. You're going to be changing all the time,
Right.
and you're going to find that that's going to cost you on other markets where your old strategy that you hadn't changed would have done better. And then you're going to be just frustrated, and because you're going to kick yourself saying, oh, yeah, stupid me, I shouldn't have changed it. And you're in this mode where you're just setting yourself up for failure, setting yourself up to get mentally beat up. And so if it's not broken, don't fix it. And but if it is, if there are new things coming in that you can identify, then there's room and logic to try to go through a process to start from scratch, go back and simulate, go back and incorporate whatever this new whatever hole filler is, and off you go, and then you can trade that in the future. So there is a time to think about changing. I haven't kept every strategy exactly the same for everything, but I will say this: my buy sell engine for my futures right now is exactly one of the strategies we used at Trendstat back in the 80s.
Right.
So
But on
what
the
are
other
we in the
hand,
20s? That's 40 something years now. I've been using the
and
same
still
thing.
working.
It works
Great.
better sometimes. It works worse some of the other times. But the thing is, I in the seminar, I have a graph that is so cool to show because I have five different buy sell engines, and I have some market like crude oil, and it's going to break out and have a big run. I knew that, and I pull it off of my broker screen, and then I lay these 5 indicators on there, and I show where they all break out on that one trade, and they're all within 2 days. They're all either today or tomorrow. They all break out, and the breakouts are all this little tiny area on the chart. Meanwhile, the chart, the crude oil market goes, huge. So why are you quibbling and obsessing over whether you bought it here or bought it there? You
Right.
picked up all of that. That's what counts. And I think that's what people lose sight, especially if you're sitting there all day long. The new traders that don't have anything better to do and they're trying to get better at their craft, they sit there glued to the screen and they get mesmerized by all this noise. And I think that they can't pull back from that and think strategically because their emotional buttons are
Yeah.
getting pushed constantly. I would advise people, if there's any way to do it, is to trade during the trading day. And I'm talking trade like systematically, mindlessly, whatever. Follow your strategies. If you're a discretionary trader, develop some rules and be a good discretionary trader. Focus. Do not start dreaming up new ways to trade during the trading day. Close it down. You're all done. Sit back, look at your log of your trades, look at your any ideas that you wrote down, and start developing and thinking of strategies when the markets are completely closed and the emotions are done, and you don't have anything pushing your emotional button or giving you extraneous ideas that are just based on noise. That's not fruitful.
By the way, I found in your book an article which you quoted, which says that actually the title is "If we are so smart, why aren't we rich?" And it tells about people with a very high IQ, which produced very low returns. Which apparently seems like the IQ is not correlated with the returns. So,
I have a great story on that one. I ran into a PhD mathematician at a conference, and he listened to my talk on trading strategies and stuff, and we kept in touch. No, it was actually after the trading. Actually, the seminar was over or whatever, and I was done speaking, and he came up and we were chatting. He said, "I have. I'm a programmer. I'm a mathematician, PhD in math. I I've been having a real struggle trying to figure out what I'm going to do." And I said, "Oh, well, tell me your story." And he said, "Well, I came up with a basic strategy, and then I added some other things to it, and I added some position sizing, and I added more markets, and I've added additional strategies now, and I've spent the last 2 years doing nothing but simulating." And I said, "Well, how come you've never traded?" And he said, "Well, I don't feel like it's finished yet." And I said, "The way you're going, it's never going to be finished. You'll never ever take the first trade. You got to get out there and figure out what the real world works like a little bit, how your models react to it, adjust, come back and do it again, and get better and better." And he had no clue, but he was brilliant. I mean, he blows me away on math. I'm pretty good with math, but I was never the valedictorian or anything. I can handle calculus and a lot of pretty severe math, but it's not my favorite thing. I can understand it at best, and I can always refer to some place to figure out what I can't remember from college, which was 45, 50 years ago. And this guy was brilliant and never even made a single trade. That's that's so perfect as an example of what not to do. You want to come up with something that's simple,
yeah.
easy to reproduce, that you really, really understand. I have another example. My former partner a long, long time ago was doing mutual fund timing, and he used to write down rules in a little book. And I came back from a trip, and he had, you know, we'd done some trades, and some trades were losers, but then he'd say, if we had done that, we wouldn't have had that losing trade. So he'd write another rule down, and he had rules and rules and rules, and if this, you got to do this, and that's got to be, the volume's got to be this, and it's got to be hitting new highs, it's got to be hitting this indicator, and it just kept getting more and more complicated. I came back from the trip, walk in the door, And I said, "Hey, did we go long the mutual funds?" And he says, "No." I said, "Huh, I would have thought we would have got a signal by your rules." He says, "No, let me show you." He pulls out the book and he starts going through, starts reading them out to me. And I said, "Okay, so that would be a positive." Yeah. Okay, so that would be a positive. Yeah. And that would be a positive. And then he gets to the final one and he says, and and then this. And I said, "So we should be long." And he goes, "Oh my God, I missed the trade." He had made it so complicated he couldn't even
Right,
figure out what he was doing anymore.
right.
And that just I shook my head and walked out of the room. I mean, uh, you know, there's just no point to making something complicated. It doesn't add value over the long run. Jack Schwager has a term called degrees of restriction
Mm.
that I love. The more parameters that you put into a strategy, the more you restrict the strategy from being robust and being able to react to different things. You could make a strategy with so many rules. And you got to have the stochastic below 20. You got to do this. You got to do that. You have 10 different rules. You'll never get a trade because no trade will ever achieve all those things at the same time. Or you'll trade once or twice a year. What usefulness is that? It's just not going to help you very much. So I think keeping things simple, trying to keep your parameter sets as low as you can possibly do to get the job done is a very useful thing. I like Jack's term, degrees of restriction.
Yeah,
That's
that's a good
exactly
one.
what it seems to me to be.
But
Yeah.
still, people prefer complexity over simplicity, and even as there was a saying, the complex things are easier. It's easier to sell them, also. And people, they think that more complex solutions are better, which is
Hmm.
typically the opposite. If you
Yep.
have a simple solution, it's better, and you don't have to even check. You can even calculate in your head, probably
Hmm.
sometimes. So
Exactly.
it's and you can feel it, and you can understand why you are opening a position, not just because you have to calculate some funny formula. But
There you go.
thanks.
Precisely.
But is this time different? Because I often hear that. Well, okay, so I have some strategy. It worked fine in the past, but now with all this money being printed, everything will be different. Or maybe sometimes people are even involving the politics biases towards trading and stuff. So first of all, is this time different if we consider indeed this action which is taken by the central banks? And do you think that it may indeed affect, or maybe already did, the markets and eventually the models?
What what I find is that throughout my what pushing 50 years of various forms of trading in my life, it always I've heard that statement asked of me numerous times. Is this different? The crash of 87, 23% down in one day. I lived
Yeah,
through that. The two Iraq wars, oil goes from 32 to 40 and ends up the next morning at 22. Uh, Lots and lots of things that people think are different. And yet, what happens to the markets? They move. They go up, they go down, they go sideways.
yeah,
Um, with that much money coming in, you could argue that you're creating inflationary pressures and you're creating a bias to the upside. Because if $10 or a 10 PE, a dollar of earnings, the stock sells at 10, it's a 10 PE. If inflation makes the value of that dollar worth 50 cents, then all things being equal, that same company might make 20 or $2. And if it sells at the same PE, it would be at 20. Well, if you bought the stock at 10, it would be worth 20 now. You'd make 100%. And that extra money that you just made didn't change your life at all. Your net wealth is the same because the 20 spends the same way that the 10 did. But
mm,
you could have made a profit on the trade. So I think in terms of trading, I'm a little more biased the way governments around the world are. It's not just the US, but
yeah,
a lot of the ECB, European Central Bank, and so on, they all seem to be trying to, I don't know, get an economy going when they're making moves. and being they're setting their governments and their budgets up to be, I think, anti good economy, and then trying to spur the economy on by pumping more money. It's the wrong approach. Let the economies do what the economies do, and you don't need to pump any money. Then you have real growth that's sustainable and beneficial to people. But that being said, I'm not running the ECB or the Fed. So as a trader, I'm sitting there saying, if this causes the stock market to just keep going up for the next 5 years straight, I'll be long. I'm a trend follower. I don't care.
Right.
If,
Right.
on the other hand, this whole thing caves in and we have 80% down in the S&P 500, I'll be short.
Right. Right. So
I may not like that as a human being because I suspect if the stock market in the US drops by 80% sometime in the future, I think the normal person's life is not going to be a lot of fun. We're going to have that could be
yeah.
at least a recession. It could be a depression. It could last for years. Businesses could fold. Jobs could be lost. Homes could be lost. It could be really ugly. But from a trading standpoint, which is what we're talking about here, there's no reason why large movement to the downside couldn't be exploited just like large movements to the upside. So, to help protect your own portfolio and your own personal life, you have to think both directions and you have to be ambivalent. You have to be able to say, you know, if the market goes down, I'm going to go with it. If the market goes up, I'm going to go with it. Quit, quit predicting with your biases, politically or economy or what the interest rates are going to do or all those things. Get out of the predicting game and get into the trading game, which is to say,
Right.
right now, the market is very near new highs. We've had a couple days off. It's up again this morning that we're doing this interview on, and so I guess I'm, long. I'm enjoying the ride, whatever it is.
Right. As
I,
you say, the market will do what the market will do.
exactly.
But by
I
the
love
way,
that. Even my wife has used that when I tell her what the markets are doing in the morning. That's what she comes back with now. She puts these words that I say back into my ear.
um, I actually also used this saying because I wanted to talk about the active and passive approach.
Okay.
Um, because people who are following passive approach, they also may say that the market will do what the market will do, and they are just buying and then holding the market forever, or at least they think they will. How do
Buy
you
and pray, buy and
buy and
pray.
pray? Sometimes it converts to
It's
that. Indeed, if you have a collapse 50%, then and if that lasts for years, then you have to
good
really
luck with that.
yeah. So how do you see that approach? Because on the other hand, the Boglehead or what Jack Bogle did, or the index investing is also very popular and becoming very popular. How do you see that if you compare to the active approach?
Well, I'll talk about a number of different topics here. First of all, I believe the reason why it's become so popular is there's been a huge upward bias in the last even couple decades to the stock market. So it makes sense that if you are working as a busy doctor or a lawyer or accountant or whatever, you just don't have time to sit there in front of a computer. You don't understand the markets. You barely know what a stock is. Just go buy a Vanguard index fund and away you go. And Bogle gets some more money in his funds. And, that works great when you have a strong upward bias as long as you can stomach the declines along the way. As recently as COVID crash for like 32% or something on the S&P in a very short amount of time, that kind of hits the mental side again. And a lot of investors probably sold out and said, this stock market's not for me. I just took a hit of 30% of my money. I can't afford to lose anymore. I'm out. And then, of course, they missed the beautiful run up. And that's the problem with that strategy is psychologically, it's not lined up with what most people have as their wishes. Most people would be like my dad, who bought CDs at a savings and loan and thought he was avoiding all sorts of risk, not realizing that all the savings and loans could go bankrupt. But his returns was a straight line, never went down. He always made his interest. and the CD would come due and he'd roll it to another CD. That was the extent of my father's investment program. And that's what people would love to have, except they would love to have it be 20% a year, straight line. Good luck with trying to find that too. And so the reason I'll talk about risk a little bit. There's a lot of people that buy and hold, and guys like my father who go into CDs or in real estate or all these other different places you can stick money, that take the attitude that there's risk out there. And by doing this, whatever that strategy is, I'm going to kind of avoid a lot of risk. I'm going to be in real estate. Real estate always goes up, right? Not going to have risk. Well, you have risk. You just don't have a price in the Wall Street Journal every day or on a quote machine of your real estate property going up and down. But if you were to sell it on any given day, it might be worth more or less on a given week or month or day. And it's just that stocks and futures and currencies and stuff like that are quoted tick by tick, so or pip by pip. And so the way I look at risk is, and the reason I like trading and why I think trading to me psychologically is easier on me, is that I'm not ignoring risk. I'm saying, yes, there's risk out there everywhere: risk of leverage, risk of defaults, risk of corporate risks, risk of market crashing, lots and lots of different risks. But what am I doing? I'm attacking those risks. I'm designing strategies to say, I know the market could go down 80 cents on a dollar, leaving me with 20. If I'm buy and hold, I'm going to have $20 for every $100 that I put in. But if I trade and I say, okay, I'm going to come up with a trend following model that will measure the downside. And when it gets to this point, I'm throwing on index futures hedges and I'm going to make money as the market falls to offset the losses that I'm taking elsewhere. So I'm attacking the risk, knowing that I can attack that risk and knowing that I am going to do it because I'm disciplined and I've got the systems in place and the stop orders are sitting there on the screen right now. I know that if today's the day it all caves in, I'm covered. So I can be Mr. Serenity. I sleep well at night. I know I've identified as many risks as I can handle and I've attacked them. I think that makes a lot more sense to me than to ignore them and to say, okay, I'm going to buy and hold. And yeah, I know the stock market could go down, but I'll just try to hold forever. And then when it happens, you can't do it. And you're trying to put it either out of your mind or ignore it, or you're trying to hope that it doesn't visit you. That's a terrible way to invest.
Right. In your book, you put a chapter titled Timing the Market Revisited, and there you just outline that basically it's not only about the profit you make, but also how deep the drawdowns can be. So, for example, if you can have, let's say, 10% annually, but in the meantime, you have 20 versus 50% maximum drawdown, that's a big difference.
Sure
But
is.
but on the other hand, people who are towards index funds, they say that, for example, they quote a SPIVA S&P index versus active report when they say that, look, after 15 or 30 years, most mutual funds, they are below the index. So as a proof for the fact that basically the active investing doesn't work. And if we just, okay, I know trend following is using the futures contract, but if we just take mutual funds, why do you think indeed they are losing against the market? Because that's the fact. I mean, most of the, I'm not saying all funds, but most of these funds are indeed below the average.
The reason for that is, and I think Bogle realized it way back when, where the Vanguard was probably the biggest proponent of this, is that the large mutual funds with billions, and I never managed billions, so I didn't have that problem, but uh, I would have had it if I've gotten up that large. And I think that when you are up in the billions, you are forced to buy a lot of the big names because there's enough volume and capitalization so you can afford to own them in your fund and gobble up a lot of these assets that you're required to keep fully invested. And there's a lot of legal requirements if you study, and most people don't. But being in the money management business, I had to deal with the SEC and the and the NFA, National Futures Association. And these rules sometimes force investment management's hands on how they can approach putting money into their mutual funds and what stocks they can buy and so on. So because of that, if you start tracking a portfolio of a very large cap mutual fund that's actively managed, and over here, the index fund that has very, very low costs to the investor and low costs of transaction because it just sits there in the same S&P 500 stocks, you're going to see that the index fund has maybe anywhere from a percent to a percent and a quarter or something like that many times advantage. So
Yeah.
over time, that's an extra burden that the active manager who's really owning about the same stocks that the index fund has got,
Yeah.
it's hard for him to get ahead because he's carrying an extra three quarters to 1%, 1.25% to pay for all of the things he's got to go to do his active stuff, to commissions, to market the fund and everything else. Over here, the index fund just sits there and just does its thing and doesn't have to move or cost commissions or charge a lot or anything because it's mindless. And that's why that happens. But now, if I take that same index fund and I give it to the average, my dad, who doesn't like any fluctuation in price, and you put them through a 50% down, 2000 crash of tech stocks, 2008 real estate debacle that everything fell apart, 50 cents on a dollar, the 32% COVID crash. I mean, a guy like my dad could never live through half of that. He'd be done with it. He would never ever get in it again. If you take and time that same index fund and cut that drawdown down substantially and give him some of the upside that would give him more money than his CD, he would be a happy camper. And this is
Right.
what a lot of managers miss. The big Wall Street types, they're used to rolling in the risk and gambling and whatever. I remember Van Tharp said something like 30-40% of all of the traders out there in the world on Wall Street would certify for Gamblers Anonymous. I mean, they're just gamblers.
Yeah.
Well, if you take all those folks and you look at how they structure what they do versus what the average person wants, there's a mismatch in many, many, many cases. When I designed what I was doing at Trendstead, I was always trying to think about my clients and what they would want, not what I would want. I trade differently today than I did at Trendstead because I'm got me as a client now, and I'm a different client than my average client. I know too much. I know a lot more about risk. I know a lot about more about risk management. I know a lot more about futures and markets. I mean, I could never convince my father to get into futures. That'd be ridiculous. He wouldn't even, because he's heard that that's dangerous. He can't even believe that I got involved in it. I've been doing it 50 years. It's not any more dangerous than you make it. You can make it dangerous, or you can make it so boring that it's like watching paint dry. And you can dial it in anywhere in between. And where I dial it in is for me now. Used to be I dial it in for the clients. And I think that that's something that a lot of money managers are very egotistical, and they trade the way they want to trade because it's the way they think, the world should go. But their clients can't handle it, and they don't see it. And
But
so they end up bringing money in and out it goes. Bringing money in, out it goes every
understand.
cycle. And they never figure it out.
But do you see a place for passive approach for all these people who, as you said, doctors or people who are really dedicated to some other activities in life, and then they don't have even time to check daily their accounts? And if they are aware of the fact that indeed there can be a decline like 30-50%, then they indeed are okay with it. So in that case, would you see it as a valid approach, or you
The
don't
only way I
really
can
like
see
it?
it, the only way I can see an outside investor outside the mutual funds buying and staying with something is things like, and I'm not saying we're the only one that did it, but I just became a couple years ago chairman of Standpoint Funds, Standpoint has 75 different futures markets along with 50% global ETFs, buy and hold. Why do we do that? Eric Crittenden, who's a brilliant guy, he's the chief investment officer, said, look, if I get exposure to 75 global markets that could go up or down, and I can exploit them two directions, and then I have these ETFs over here, isn't that what most people are trying to expose themselves to get diversification in today's world? But the problem is they can't get it in today's world from very many places. There's a few of us out there, but there aren't very many that can cover that much ground and then allow the investor to just buy the mutual fund that is doing all this thing for them at a fairly low cost and then just hold it because we're taking care of attacking all that risk for them. Then they don't see the ups and downs like the normal investor out there buying the Vanguard S&P fund, and therefore their mental side is placated and they're allowed to be a strategic investor and just think of the long term, and they don't get that shocking experience along the way. So we've done that with Standpoint at great expense, by the way. Oh my gosh, $500,000 to form the fund. The lawyers involved in trying to create a active 40 fund with all this stuff in it uh, are getting rich. They unbelievable. But we finally pulled it off and started it up on January 1st of 2020. Had a banner year last year, having a banner year this year. Made it right through the COVID crash. I think they were down like 8% or something. It was something very small compared to the market. I forget the exact number, but nothing that's going to scare anybody. And then caught the up move, made a bunch of money there. So that type of fund, and there are a couple of other ones out there like that. I know Milburn has a couple funds. They're getting pretty large. I don't know how much effectively they can move. Milburn, a bunch of good guys I knew from the futures industry. There's a few others out there. I don't know all their names, but you can seek those types of situations out to try to get to sort of an all-weather fund that you could buy passively and hold it. But inside there, there's a lot of active stuff going on. That'd be where I think would be the best fit for most normal people out in the working world. I just don't see the average person being able, I don't care if they tell you, they swear on a Bible that they can handle a 50% down. When it actually happens, no.
So I
When they
understand
get
that.
down to half of that, 25% down, they're already getting nervous.
So I can see that dividend investing is also not your not your favorite approach then.
If you're just doing that and nothing else, there's no timing of the investment. You're going to expose yourself to some fairly severe drawdowns. The dividends are not going to cover it. The dividends, the higher the dividend, the more you're likely to have less movement up and down. Dividends become sort of an anchor, as in the case of a boat, where you've dropped the anchor, and that's the dividend. The larger the, if you're paying 8-10% dividend out of a company, a utility or something, it's going to really be hard to move that very much up or down in price. So you're buffering your downside some, and you're of course getting dividends, which is helping cash flows and bring keeping your portfolio somewhat buffered. But you still in a if you assume the stock market goes down 80%, those high dividend stocks are going to be down 30, 40. And for a normal dividend person that really is a little gun shy and thinks he's doing dividends in an effort to try to buffer the the downside, he is helping himself some, but not as much as he might think. And he might want to have some hedging approach or ability to, I don't know, buy puts or do something that would help offset some of the declines that he's likely to suffer over the next couple decades.
All right. Thank you for that. We are reaching slowly to the end, but I remember it was a year or 2 years ago, I think, you put on Twitter information that you're looking for some programmer, that you're starting up some project. And And yeah, so I just wanted to ask you, has this project taken off, and what was it, or what is it actually? Maybe it was
Um,
related to trading, as far as
I
I
can't I
remember.
can't tell you the name of it yet. Um, I was testing it yesterday afternoon. It is not ready for prime time. I am working with a programmer up in Michigan, and we're building a cloud-based trading platform that'll have a subscription model to it. It'll have data included. I did go on the website this morning and looked at yours, and perhaps if you want, I'd be happy to take a look at it and beat it up a little bit and give you
Sure, sure.
my frank comments. If it's useful for you, I can try to do that for you.
Thank you.
But I've done that to a number of trading platforms, by the way, so I'm getting pretty used to how I go about beating trading platforms up lately. Um, we're going to try to be able to trade futures, ETFs, and stocks. It will not have anything day trading wise coming out of the gate. It'll be all once a day position trading types of things. Um, it should be extremely fast. The servers, depending on how much you want to bump them up, can really fly. So doing a simulation for like 10 years of data across 21 ETFs with say three different indicators, position sizing, algorithms, everything, less than 10 seconds. You'll have the results
Interesting.
back, and you can debug it in spreadsheet form. You can get a graph. You can see which markets, how the profits and losses by ticker. So you can see where your losses came from, where your gains came from. Helps you go out after that hole and see what's going on there, and if you can puzzle over that and improve your trading. A lot of
All right.
interesting return to risk statistics. Um, Pretty easy to use, should be intuitively obvious for most people. So that's kind of the goal. Where we are and how soon it'll come out, I have no clue. I've given up trying to figure out a date that I think makes sense to me, because it just we keep finding things that we have to make better. But it's better today than it was 6 months ago. So
All
at some
right.
point we'll have to pull. We'll have to say, okay, this is good enough. We're going to have to go out in the world with it and see what happens. But that's where we are right now.
So I wish you good luck with that, and
Yeah,
please let me know when you launch it. I'm very interested about it.
yeah.
Is there anything else that maybe I didn't ask during our conversation that you would like to share with us here?
Wow. Just that I'm having a great time. Some of these interviews have been a lot of fun. I meet people like yourself who are fascinating people, and make new friends around the world. And when I was back in the money management business, it was focused on Trendstead, and it was just grinding. And I have to say, I have a lot more smile on my face today than I did back even when I was retiring and just deciding to not even trade for a whole year. I took a year and a quarter off from trading, and the only thing that got me back in was my wife uh, coming to me after we got engaged. And she says, I guess you probably should manage my portfolio, since you're this legendary trader. And so I took a look at it, and we started managing money again. And I didn't manage for other people, just for her and myself. But what I'm finding is I really enjoy keeping in touch with people around the world. Enjoy the ride.world on my shirt here is a fun thing to do. I've got all these interviews that I've done are all in one place at enjoytheride.world. And I'll try to, when you get done with this one, I'll put links to it as well. And if some new trader wanted to just get a sense of the psychology of trading and some of the philosophies of attacking risk versus passive risk, differences between trend following and mean reversion, other things, gosh, there's so much good material out there that on just my interview page, it's all free. And you can just listen to it. And from there, I like, for instance, in your case, when I put this interview up there, I'll have a key or a link to the specific interview, but I'll also have a link on your logo over to your page. And you have lots of podcasts. So now you can go off and listen to all of your podcasts, or you can listen to Coville's podcast, or you can listen to, Aaron Feifeld. There's just so many other people who have interviewed me that a lot of good material there, and it's all free.
All
And
right.
there's
I will put it to the show notes, the link.
recommended books. Gosh, there's just so many different things and resources out there for new traders that I never had. Gosh, we didn't even have internet stuff going on back in those days. Back when I started, you had to call your broker. They had to call the floor. The floor wrote up a ticket. A runner took it out to the pit, gave it to a trader, had to execute it, throw the execution down on the floor. The runner would have to get it off the floor, take it back to the side, call back the broker, and call me. It might take 45 minutes.
Wow.
Now you just do it live, and you can see the fill about a second or two later. And
Real time. Yeah.
yeah, I mean, it's insane. The world's a very different place, but it still operates the same. It's still buying and selling. It's still trends. It's still ups and downs and sideways. The timing of everything with computers has gotten faster, and where the New York Stock Exchange used to do 10 million shares a day and pop the champagne cork, now you do a billion shares a day. And so a lot more volume. Computers can handle it, um, but the world's the same.
All right, Tom. Thank you so much for your time. I really enjoyed that, and I'm sure that the listeners also will find a lot of value in what you said. So thank you so much, and as you say, enjoy the ride.
Yeah, enjoy the ride.
Thank you. Bye bye.
Bye bye.